4.24%, March 12th, 2026. The 10-year Treasury yield just hit 4.24%, a 5-week high. Your bank's risk management team is watching that number closer than the stock market, closer than unemployment, closer than anything else on earth. Because that number, 4.24%, is quietly destroying balance sheets across hundreds of American banks right now. It's pushing unrealized losses back toward crisis levels. It's freezing the housing market. It's eliminating the Fed's ability to cut rates. And it's doing all of this while a war in the Middle East, oil at 85.90 per barrel, and an incoming hawkish Fed chair pile pressure onto a banking system that was already fragile. Your bank won't send you an email about this. Your financial advisor probably won't mention it. The mainstream news is covering oil explosions and geopolitical drama. But inside every major bank in America right now, risk managers are running stress tests, liquidity models, deposit outflow scenarios, and the number breaking their models is 4.24%. Metropolitan Capital Bank already failed in February, the first U.S. bank collapse of 2026. Routine, regulators called it. It happened the same day gold and Bitcoin crashed from the Kevin Warsh nomination shock. Nobody noticed. The system absorbed it quietly. The question, does it stay quiet? Hi, I'm Roxanne. Let me show you why 4.24% is the heartbeat of the banking system right now and what it means for your money. Before we get into the crisis, you need to understand what a Treasury yield actually is. Most people don't, and without this foundation, nothing else makes sense. The U.S. government borrows money constantly for defense, social security, infrastructure, everything it spends. It borrows by selling bonds called Treasury securities. An investor gives the government $1,000. The government promises to pay back $1,000 in 10 years, plus annual interest payments. That interest rate is the yield. When lots of investors want treasuries, high demand, the yield goes down. The government doesn't need to offer much interest to attract buyers. When fewer investors want treasuries, demand falls, the yield goes up. The government has to offer more interest. The 10-year Treasury yield is the most important interest rate in the world, not because of its direct effect on government borrowing, but because of what it does to everything else. Mortgage rates follow the 10-year yield. When the 10-year rises, your mortgage gets more expensive. Right now, with the 10-year at 4.24%, 30-year mortgage rates are hovering between 6.5% and 7%. Earlier this year, rates briefly touched 6.18% before the Iran war, and Warsh nomination pushed them back up. Corporate borrowing rates follow the 10-year yield. Companies pay a spread above the 10-year when they borrow to expand or hire. Higher yields mean more expensive corporate debt, which means less investment, less hiring, slower growth. And here's the critical part for banks. The value of every existing bond moves inversely to the yield. When the 10-year yield rises, bonds that banks bought when yields were lower are now worth less. A lot less. This is called an unrealized loss. And right now, hundreds of billions of dollars of unrealized losses are sitting on American bank balance sheets, hidden in footnotes, dangerous and growing. Let me explain exactly how a 4.24% Treasury yield becomes a liquidity crisis for your bank. During 2020 and 2021, the Federal Reserve dropped interest rates to essentially zero to fight the pandemic recession. Banks were flooded with deposits, stimulus checks, corporate borrowing, government spending. Trillions of dollars flowed into the banking system. Banks had more money than they knew what to do with. Loan demand was weak. Businesses weren't borrowing to expand during a pandemic, so banks did what they always do when they have excess deposits and nowhere to lend. They bought government bonds, treasuries paying 1%, mortgage-backed securities paying 2%, safe, liquid, reliable income. Then, starting in March 2022, the Federal Reserve began raising interest rates at the fastest pace in 40 years, from near zero to over 5% in 18 months. Overnight, those bonds banks bought at 1% and 2% became worth dramatically less. Why? Because why would any investor pay full price for a bond paying 1% when they could get a new bond paying 5%? The bonds didn't default. Banks weren't going to lose the money as long as they held the bonds to maturity. But the market value of those bonds collapsed. On paper, hundreds of billions of dollars of bank assets were now worth less than what banks paid for them. These are unrealized losses. Unrealized because banks haven't sold the bonds yet, haven't locked in the loss. The loss exists. Any investor can see it, but it doesn't appear on the income statement until the bank is forced to sell. Here's the brutal reality. Unrealized losses are paper losses. Banks don't lose money unless they sell the underlying securities before maturity, but banks might need to sell, and that's when paper losses become real losses, and that's when banks become insolvent. This is exactly what killed Silicon Valley Bank in March 2023. SVB had loaded up on long-term treasuries and mortgage-backed securities during the pandemic. When rates rose, those securities lost value. When depositors started withdrawing money, SVB had to sell those securities to raise cash. The paper losses became real losses. The real losses wiped out SVB's capital. The bank collapsed in 48 hours. That was March 2023 when rates were rising toward 5%. Rates subsequently fell. Banks got some relief. Unrealized losses moderated. The crisis seemed to pass. But then the Iran war happened. Oil spiked toward $120. Inflation reignited. The 10-year Treasury yield, which had been falling in anticipation of Fed rate cuts, reversed sharply upward. 4.21% on March 9th, 4.24% on March 12th, and every basis point that yield climbs is another wave of unrealized losses appearing on bank balance sheets across America. As of March 12, 2026, the yield on the U.S. 10-year Treasury note climbed to 4.24%, a 5-week high. What drove it there? Oil surged for a second consecutive day as the prospect of a prolonged Iran war overshadowed the IEA's historic 400 million barrel reserve release. Iraq halted operations at its oil terminals after 2 tankers were targeted in Iraqi waters. The war is not over. Oil is not coming down. Oil is still $85–90 per barrel today after spiking to $120 on March 8th. And as long as oil stays elevated, inflation stays elevated. As long as inflation stays elevated, the Fed cannot cut rates. As long as the Fed cannot cut rates, Treasury yields stay high or go higher. This is the chain reaction, and your bank is sitting right in the middle of it. Here's the verified damage. According to the FDIC's Q4 2025 quarterly banking profile released in early 2026, total unrealized losses across the banking system decreased to $306.1 billion, the lowest level since Q1 2022. That sounds like good news. It's not, because that number dropped primarily because some banks sold underwater securities and realized significant losses, taking the hit to clean up their balance sheets. More importantly, that $306 billion figure was calculated when the 10-year yield was around 3.94% in late December 2025. We're now at 4.24%. Every 10 basis points the yield rises adds billions in unrealized losses. Dr. Rebel Cole, the eminent scholar at Florida Atlantic University's College of Business, who produces the country's most comprehensive tracking of bank unrealized losses, put it bluntly: banks are not yet in the clear. The 10-year Treasury yield has been extraordinarily volatile for the past 2 years as inflation has increased. As of Q2 2025 data, the most recent comprehensive analysis, 47 banks with more than $1 billion in assets had unrealized losses exceeding 50% of their Common Equity Tier 1 capital. A bank that loses half of its CET1 capital would be forced by regulators to take remedial actions, raising new capital, seeking a merger partner, or in worst cases, closure by the FDIC. 4 banks had losses that exceeded their total equity capital. Union City Savings Bank, 172%. Citizens State Bank, 121%. Green Dot Bank, 108%. First America Trust, 104%. These are not hypothetical scenarios. These are real institutions with real depositors carrying unrealized losses larger than their entire capital base. and that was when the 10-year yield was lower than it is today. The FDIC continues to monitor unrealized losses on securities portfolios across the banking system. Their official statement: although the figures have improved somewhat, the losses remain large enough to strain the balance sheets of weaker banks, especially while funding costs stay elevated. Translation: the problem is not resolved, it is active, it is live, and the 4.24% yield is making it worse today. Let me make this completely concrete. How does the 4.24% Treasury yield actually affect you right now in your daily financial life? Your mortgage. The 30-year fixed mortgage rate is directly linked to the 10-year Treasury yield. When the 10-year rises, mortgage rates follow. Since August 2025, 10-year Treasury yields have stayed in the 4.25% range. In that environment, 30-year mortgage rates have hovered between 6.5% and 7%. Mortgage rates hit a 3-year low earlier this year, briefly touching 6.18% before the Iran war, and Warsh nomination pushed yields back up. Those low rates are gone. With the 10-year at 4.24% and inflationary pressure building, the spring housing market economists were cautiously optimistic about is now facing serious headwinds. Think about what that means in real dollars. A $400,000 mortgage at 6.2% costs $2,145 per month in principal and interest. At 7.2%, a level that becomes plausible if yields push higher, that same mortgage costs $2,124 per month, an extra $279 every single month, $3,248 per year. That's real money out of real budgets. Your car loan. Auto loan rates are tied to shorter term rates, but they respond to the broader interest rate environment. The average new car loan rate is now running above 7%, with the Fed holding rates at 3.5 to 3.75% and showing no signs of cutting before summer. Car affordability is near historical lows. Americans who were waiting for rates to fall before buying a vehicle are waiting indefinitely. Your savings account. Here's one area where higher yields actually benefit ordinary people. Money market funds and high-yield savings accounts are offering 4 to 5% annual yields because short-term interest rates remain elevated. This is real money. A $50,000 emergency fund earning 4.5% generates $2,250 per year in interest, more than it would have generated in the entire 2015-2021 period combined. But this benefit has a dark side. Banks have to compete for deposits by offering higher rates, which means their funding costs, the interest they pay on deposits, are rising. At the same time, the long-term bonds on their balance sheets are earning only 1–2%, purchased when rates were near zero. This is called a net interest margin squeeze, and it's compressing bank profitability exactly when banks need profits to build capital buffers against rising losses. Your small business loan. Commercial lending rates for small businesses are typically priced at a spread above the prime rate, which moves with the Fed funds rate. With the Fed at 3.5 to 3.75%, prime is around 6.5 to 6.75%. A business borrowing at prime plus 2% is paying 8.5 to 8.75%. For a small business trying to finance inventory, equipment, or expansion, these rates make many projects uneconomical. Small business lending volumes are declining. Investment is being deferred. Hiring is slowing. This is the real economy impact of a 4.24% Treasury yield, felt not in bond trading floors but in hardware stores, restaurants, and logistics companies across America. I want to tell you about something that happened in early 2026 that barely made the news. In February 2026, a U.S. bank called Metropolitan Capital Bank was closed by regulators. Authorities handed its management over to the FDIC through a resolution process officially categorized as routine. Routine. That word was doing a lot of work. The closure itself was not headline news, but its timing was anything but routine. It occurred amid far larger shocks in global financial markets. On the same day, gold and silver prices recorded some of their steepest daily declines in decades. Silver crashed 33% from its January 29th high of £121.67. Bitcoin came under heavy pressure as investors rushed to offload risk assets. Over the following 24 hours, markets that remained open through the weekend moved violently with almost no pause for adjustment, reinforcing the impression that liquidity stress was spreading across asset classes. Taken in isolation, the failure of a small bank like Metropolitan Capital Bank is not a systemic crisis, but it is a signal. It tells you that the weakest institutions in the banking system are already beginning to crack under the pressure of elevated yields, tight liquidity, and compressed margins. And here's the critical detail from the Office of Financial Research, the U.S. government's own financial stability watchdog, reported in May 2025, before the Iran war made things worse. Unrealized securities losses could increase banks' vulnerability if other developments, such as a large surge in commercial real estate loan losses, make depositors nervous and trigger deposit runs. Commercial real estate loan losses. There it is, the same double threat regulators have been warning about. Unrealized securities losses plus commercial real estate stress, each problem making the other worse. Now add the Iran war, the oil spike, and the Warsh nomination on top of that pre-existing stress. The banking system is not facing one crisis. It is facing three simultaneous crises converging on the same balance sheet vulnerabilities. In 6 days, on March 17th and 18th, the Federal Open Market Committee meets for what may be Jerome Powell's second-to-last meeting as Fed chair. The federal funds rate is currently at 3.5 to 3.75%. The Fed held rates steady at its January meeting, following three consecutive cuts in late 2025. Markets are asking, will the Fed cut at the March meeting? The answer is almost certainly no. The Fed is widely expected to keep rates steady next week, with traders pricing in only one 25 basis point cut, possibly in September at the earliest, which means rates stay elevated for at least 6 more months. Today, March 12, 2026, the 10-year U.S. Treasury yield hit 4.24%, a 5-week high. That number is not just a bond market statistic, it is the pressure gauge for the entire American banking system. Banks across the country are holding hundreds of billions of dollars in bonds bought when yields were 1% and 2%. Those bonds are now worth substantially less. The losses are unrealized, hidden in footnotes, not yet visible in headlines. But they are real, and when depositors get nervous, when liquidity needs arise, when commercial real estate losses accelerate, those hidden losses have a way of becoming very visible very fast. We already saw one bank fail this year, Metropolitan Capital Bank, routine closure, the FDIC called it. It happened the same day gold and Bitcoin crashed. Nobody noticed. The question, does the system continue to absorb these pressures quietly, one small failure at a time? Or does the combination of 4.24% yields, energy-driven inflation, compressed bank margins, unrealized losses, and the removal of the Fed's balance sheet backstop create a stress event that is no longer quiet? Jerome Powell meets with the FOMC on March 17th-18th. The April bank earnings will show us what the yield shock has done to balance sheets. The Warsh confirmation hearing will tell us how aggressive the next Fed chair plans to be, 4.24%. That's the heartbeat of the banking system right now. Watch it, understand it, because your bank is watching it every single second of every trading day and bracing for what comes next. This is educational analysis based on publicly available FDIC data, Federal Reserve reports, and verified market information, not financial advice.